As in the previous uploaded PPT of leverage chapter, we discussed about financial leverage and how it helps in increasing profits as well as losses if suffered. In this video, I would explain you about operating leverage. As we all know that leverage is an instrument to measure risk. In every business, two kinds of risk are there, operating and financial. In this lecture, we will focus upon operating risk. Operating risk is associated with operating fixed cost. Now, the question arises, what is operating fixed cost? The fixed cost that is used to run the day-to-day activities of a business is called operating fixed cost. For an instance, rent, salary, etc. Now the question arises, why operating risk is associated only with operating fixed cost and not variable cost? The reason is that if there are no sales, there will be no variable cost, but fixed cost will always be incurred. For example, if we rent a room to run a business, till the time there is no production, no sales, no variable cost will be incurred. But we have to pay room rent, and rent is a fixed cost. Therefore, maximum loss that can be incurred in a business is fixed cost. Whether there is any sales or not, fixed cost is always incurred. Fixed cost helps in magnifying the operating revenue. How? We'll see that in the coming slides. Fixed cost can be called as fulcrum, as we all know that placement of fulcrum will determine how far an object will move. Similarly, fixed cost operations will decide what will be the impact of changes in sales on changes in operating profit. Now let's take this hypothetical example to understand this concept, that how fixed cost can help in increasing the percentage change in EBIT. In situation 1, let us assume that there are the sales of 20,000. Variable cost incurred is 50% of sales, that is 10,000. So what will be the contribution? Sales minus variable cost. So 20,000 minus 10,000, contribution is 10,000. Let us assume that fixed cost incurred are rupees 5,000. So EBIT will be 5,000. Contribution minus fixed cost. EBIT is also termed as operating profit. Now, what is the formula for operating leverage? Because as I said that fixed cost plays a crucial role in determination of operating leverage. So we are just going to take both of the things that are near to the fixed cost. One is contribution and one is EBIT. So it is simple. The one that is above the fixed cost will be the numerator and the one that is below the fixed cost is your denominator. This formula becomes contribution divided by EBIT. Contribution is 10,000 divided by EBIT of 5,000. Operating leverage is 2 times. Now let us assume that next year the firm increases its sales by 10%. So sales increases to 22,000, 10% increase. Variable cost is 50% of sales. So it has also shown an increase of 10% and variable cost now incurred is 11,000. Sales minus variable cost, contribution is 11,000, again showing an increase of 10%. But as we discussed that operating leverage is 2 times. It means that if sales are increasing by 10%, double will be the increase in the operating profit or EBIT. So that is why EBIT will increase by 20%. So in this case, EBIT earlier was rupees 5,000. Now EBIT is 6,000. There is an increase of 1,000, which means that EBIT increases by 20%. So it means that if sales will increase by 30%, EBIT will rise by exactly 60%. If sales increase by 50%, EBIT will rise by double the 50%, that is 100%. Now let us see one question. Hereby in this question it is given to you that fixed cost are rupees 50,000, variable cost is 70% of sales. Sales of 2 years are given to you. In the previous year there is a sales of 2 lakh rupees and now in this year there is a sale of 2,50,000. We have to tell that what is the percentage change in sales and percentage change in operating profit in two situations. Number one, if fixed costs are not there, we call it as no leverage situation. Why we call it as no leverage situation? टेक एन एग्जाम्पल ऑफ रनिंग द कार. आप कार में जितना बड़ा गियर डाली जाते हो, लाइक फॉर एग्जाम्पल फ्रॉम सेकेंड गियर यू शिफ्ट टू थर्ड गियर, यू शिफ्ट टू फोर्थ गियर, द मोर द कार विल स्पीड अप. सो सिमिलरली अगर फिक्स्ड कॉस्ट होगी तो उसे हम एक लीवरेज सिचुएशन कहेंगे. हम कहेंगे कि दैट देयर इज अ, you can say the firm can accelerate with its increase in the profits. So seeing the two situations, one where there is no leverage, so it means that contribution and operating profit will be same because fixed costs are nil. So sales 2 lakh rupees, variable cost 1,40,000. What will be the contribution? Exactly, sales minus variable cost, you have the contribution of 60,000. Now in current year, sales increases by 25%, that is 2,50,000. So similar increase is recorded in contribution 25%, and because contribution and operating profit is same in this case, so operating profit also increases only by 25%. Now come to the leveraged situation. Sales of 2 lakh rupees, variable cost of 1,40,000, so contribution we have 60,000. Now the fixed cost are rupees 50,000, so it means your operating profit is 10,000. In the current year, operating profit comes to be rupees 25,000, which means that initial increase in sales is resulted as an increase in the operating profit of 150%. So it means that by the fixed cost, because there were the fixed cost, operating profit tend to rise by 150% on a mere increase of 25% in sales. Thank you. Happy learning.